What if your government kept more than half of everything you earned? Imagine earning $100,000 a year. You worked for every dollar. Late nights, early mornings, years of building your career. Now imagine opening your paycheck and seeing that $57,000 of it is gone. Not stolen, not lost, taken legally by your own government. In some countries, this isn't a nightmare scenario. It's Tuesday. There are nations right now where the combined tax burden on a working professional exceeds 60% of their gross salary. Income tax, social security contributions, municipal surcharges, solidarity taxes, layers upon layers that most people don't even realize exist until they see the final number on their pay stub. And here's what makes it worse. In most of these countries, you can't negotiate, you can't opt out, and moving abroad comes with its own set of penalties. In this video, we're breaking down the countries with the highest personal tax burdens in the world. Not corporate tax, personal. The money taken directly from your paycheck before you see a single dollar. Some of these will shock you. Others will make you wonder why anyone still lives there. And at least one will make you rethink everything you know about the relationship between taxes and quality of life. Before we rank these countries, you need to understand what tax burden actually means, because it's much worse than the headline income tax rate suggests. When politicians talk about a 45% tax rate, they're only showing you one layer. In reality, your total tax burden includes your marginal income tax rate, mandatory social security contributions that come off your paycheck before you even see it, employer-side contributions that reduce what companies can afford to pay you, municipal or regional surcharges that stack on top of the national rate. And in some countries, church tax, yes, a literal tax for belonging to a religion. When you add all of these together, the effective tax burden in some nations exceeds 60%. A person earning $80,000 might take home less than $35,000. And that's before they pay 25% VAT on everything they buy. We're going to look at each country's total burden, not just the income tax headline, because that's the number that actually determines how much of your life you're working for the government versus yourself. If you asked most people which country has the highest tax burden on workers, they'd say Sweden or Denmark. They'd be wrong. It's Belgium. A single worker earning the average salary in Belgium faces a total tax wedge of 52.6%, the highest in the OECD for 5 years running. But for higher earners, it gets much worse. Belgium's top marginal income tax rate is 50%, and it kicks in at just €46,440, about $50,000. That means a software developer, a mid-level manager, or a senior nurse is already in the top tax bracket. On top of that, employees pay 13.07% in social security contributions. Employers pay an additional 25% on top of your gross salary, money that could have been your raise. When you combine income tax, social contributions, and municipal surcharges of up to 9%, a Belgian professional earning €75,000 takes home roughly $38,000. That's a 49.3% personal effective rate, before spending a single euro on Belgium's 21% VAT. And here's the cruel twist. Belgium has almost no tax-free investment options. Capital gains on stocks are technically tax-free for individuals, but the government has been trying to change that for years, and interest income is taxed at 30%. The average Belgian worker spends from January 1st until July 27th working just to pay taxes. Everything after that date is actually theirs. Austria is a country tourists associate with Mozart, Schnitzel, and the Alps. Workers associate it with a 55% top tax rate, one of the highest in Europe. Austria's income tax has 7 brackets, and the top rate of 55% hits income above €1 million. But you don't need to be a millionaire to feel the pain. At €60,000, a decent but unremarkable salary in Vienna, your marginal rate is already 42%. Add 18.12% in mandatory social security contributions split between employee and employer. Add the chamber membership fee that most workers are forced to pay. And add Austria's solidarity surcharge that was supposed to be temporary after the 2008 financial crisis and never went away. The effective total tax burden on a professional earning €80,000 in Austria is approximately 47%. But what makes Austria particularly painful is the combination of high taxes with high living costs. Vienna is not cheap. A one-bedroom apartment in the center runs €900 to €1,200 per month. Groceries cost 15 to 20% more than Germany. And dining out in Vienna will cost you 40 to 60% more than Budapest, which is just 2 hours away by car. Austrians joke that they work from January to July for the government, August for their landlord, and September through December for themselves. Germany doesn't have the highest income tax rate in Europe. At 45%, its top rate looks almost reasonable compared to Belgium or Austria. But Germany has perfected the art of stacking surcharges until your effective rate makes you question your career choices. First, there's the solidarity surcharge, Solidaritätszuschlag, originally introduced in 1991 to fund German reunification. 35 years later, high earners still pay 5.5% of their income tax as this temporary surcharge. Then there's church tax. If you're registered as Catholic or Protestant in Germany, and millions are, often because their parents registered them at birth, you pay an additional 8 to 9% of your income tax to the church. Leaving the church requires a formal appointment at your local court, a fee of €30, and the social stigma of your parish being notified. On top of income tax, solidarity surcharge, and church tax, German employees pay 20.2% in social security contributions. Health insurance, pension, unemployment insurance, and long-term care insurance are all mandatory, and employer contributions match at roughly 20%. A German professional earning €100,000 and registered with a church faces a combined effective tax burden of approximately 54%. Take home about €46,000. And then everything they buy is taxed at 19% VAT. Germany's system is designed so that middle-class professionals bear the heaviest burden. The truly wealthy use investment structures, real estate loopholes, and corporate vehicles to pay far less. A factory worker earning €50,000 pays an effective rate of 40%. A billionaire with the right advisors might pay 25%. In 2012, French President François Hollande proposed a 75% tax on income above €1 million. Within months, actor Gerard Depardieu renounced his French citizenship and became a Russian citizen. Bernard Arnault, the richest person in France, applied for Belgian nationality, and an estimated 10,000 millionaires left the country in a single year. The 75% super tax was eventually struck down by France's Constitutional Council. But the damage was done, and France's regular tax system is still among the most punishing in the world. France's top marginal income tax rate is 45%, hitting income above €177,106. But the real pain comes from social charges. Employees pay approximately 22% in social contributions. Employers pay an additional 30 to 45% on top of gross salary. And France recently introduced a contribution exceptionnel on high incomes, an additional 3% on income between €250,000 and €500,000, and 4% above that. For a French executive earning €200,000, the combined personal tax burden exceeds 55%. And unlike Belgium or Germany, France also taxes capital gains at up to 30% through its flat tax, though calling 30% flat is generous. France has another unique weapon, the wealth tax on real estate, called IFI. If your property portfolio exceeds €1.3 million, you pay between 0.5% and 1.5% annually on its value, even if you haven't sold anything and have no income from it. Denmark consistently ranks as one of the happiest countries on earth. It also has one of the highest personal tax burdens. The top marginal income tax rate in Denmark is 55.9%, and it applies to income above just 568,900 Danish kroner, about $82,000. That means a senior developer, a dentist, or a department manager is already paying the maximum rate. But Denmark's tax system goes even deeper. There's an 8% labor market contribution that comes off your gross salary before income tax is even calculated. Municipal tax averages 25.1% across Denmark's municipalities. And the health contribution, while technically folded into municipal tax since 2019, still adds to the total burden. A Danish professional earning 700,000 kroner, about $101,000, faces an effective personal tax rate of approximately 49%. Take home, roughly $51,500. And then there's the 25% VAT on everything. So why do Danes consistently report being happy despite paying so much? The answer is visible everywhere. Free healthcare with almost no wait times for urgent care, free university education including a monthly living stipend of $930 for students, 52 weeks of paid parental leave, childcare subsidized at 75%, and a pension system ranked #1 in the world. Denmark doesn't just take your money. It gives most of it back in services that would cost 2 to 3 times more if you paid privately. Whether that trade-off is worth it depends entirely on what you value more: keeping your money or never worrying about a medical bill, a tuition payment, or retirement. Sweden practically invented the modern welfare state and the tax rates to fund it. The combined top marginal tax rate in Sweden can reach 52.3% when you add national income tax of 20% to municipal tax that averages 32.3%. And that's just the start. Swedish employers pay 31.42% in social contributions on top of every employee's gross salary. This money funds pensions, healthcare, unemployment insurance, and parental leave. While it doesn't come directly from your paycheck, economists agree it suppresses wages by the equivalent amount. A Swedish worker earning 600,000 kronor, about $57,000, already hits the state income tax threshold and faces an effective personal tax rate of around 43%. At 1 million kronor, about $95,000, the effective rate climbs to 51%. But Sweden has something most high-tax countries don't: a relatively low wealth tax. Sweden abolished its wealth tax entirely in 2007, and capital gains on stocks held in a special investment savings account called an ISK are taxed at a flat rate based on the account value, typically under 1%. This means Sweden taxes your labor heavily, but leaves investment wealth largely alone. It's a deliberate design choice that encourages Swedes to invest rather than spend. The result is a country where the average person pays half their salary in taxes, but builds wealth through one of Europe's most generous investment tax regimes. Finland doesn't get as much attention as Sweden or Denmark in the high tax conversation, but it should. Finland's top marginal income tax rate is 44% at the national level, but municipal taxes add another 17 to 23.5% depending on where you live. In Helsinki, the combined top marginal rate reaches 58.4%. That's higher than Denmark, higher than Sweden, one of the highest in the world. Finnish social security contributions add 10.44% for employees, covering pension, unemployment, and health insurance. Employers pay 20.36%. A Finnish worker earning 80,000 euros takes home approximately 44,800 euros, a 44% effective rate. At 120,000 euros, the effective rate climbs to 50%. And Finland taxes capital gains at a flat 30% on gains up to 30,000 euros and 34% above that, significantly higher than Sweden's ISK system. Finland also has a unique broadcasting tax of 2.5% on income, essentially a TV license that's been converted into a mandatory income tax. There's no way to opt out even if you don't own a television. What does Finland get in return? The best education system in the world according to PISA rankings, universal healthcare, 164 days of paid parental leave, and a social safety net that means homelessness is nearly non-existent. Finland is the only EU country that has actually reduced homelessness every year for the past decade. The trade-off is real, but so are the results. Most people have never thought about Slovenia's tax system. They should. Slovenia has a top marginal income tax rate of 50% on income above 82,400 492 euros. But what makes Slovenia stand out is how quickly you reach high brackets. The 34% rate kicks in at just 25,750 euros, about $28,000. A junior marketing coordinator in Ljubljana is already in a bracket that would be considered high in most countries. Social Security contributions add 22.1% for employees and 16.1% for employers. When you combine income tax and Social Security, a Slovenian worker earning the average salary of approximately 24,000 euros faces an effective tax burden of about 43%. That's on a salary that's already modest by Western European standards. Slovenia also imposes a tax on capital gains based on holding period, 25% if you sell within 5 years, dropping by 5 percentage points every 5 years until it reaches 0% after 20 years. And rental income is taxed at a flat 25% with limited deductions. The paradox of Slovenia is that it combines Eastern European salaries with Western European tax rates. A software developer in Ljubljana might earn 42,000 euros, about half what they'd make in Munich, but face nearly the same effective tax rate. It's the worst of both worlds for ambitious professionals, which is why Slovenia has one of the highest immigration rates among skilled workers in the EU. So if these countries take 50 to 60% of your salary, why does anyone stay? The answer is more complicated than free healthcare, though that's part of it. In Belgium, the average worker gets 20 vacation days guaranteed by law, plus 10 public holidays. Healthcare costs are subsidized to the point where a doctor visit costs 1 to 4 euros after reimbursement. And the pension system, while underfunded, still provides a safety net that most Americans can only dream of. In Denmark and Finland, the return on taxes is visible in daily life. You never receive a medical bill. Your children's education from kindergarten through PhD costs zero. Parental leave is measured in months, not weeks. And retirement doesn't require decades of personal saving because the state pension is genuinely livable. Germany and France offer similar benefits, though with more bureaucracy and less efficiency. Austria combines high taxes with a cultural quality of life that's hard to quantify. Vienna has been ranked the world's most livable city for 4 consecutive years. But here's the uncomfortable truth that none of these governments want to admit. The tax burden falls hardest on the middle class. In every single country on this list, the ultra-wealthy have access to trusts, holding companies, real estate structures, and international tax planning that reduces their effective rate to 20% or less. A surgeon in Stockholm paying 52% and a billionaire paying 25% are living in the same country, but playing completely different tax games. The question isn't whether high taxes can build a good society. Clearly, they can. The question is whether the burden is distributed fairly, and in every country on this list, the honest answer is no. If this video changed how you think about taxes, hit subscribe. We break down the tax systems that affect real people, not just corporations. Next up, how the IRS is hunting Americans abroad with taxes most don't even know they owe. That video is right here. See you there.